You know, it's kind of cool, Don. All the things wrong with the world, including the flash crash, including tax threats, including the dollar, including. But stocks have mounted a very strong rally. What do you make of it? What's the message here?
Sounds like an argument for contrarianism to me. but on the other hand, I'm going to be contrarian against your whole premise. I don't think things are getting worse. Things are getting better. Who would have thought just 3 months ago that Democrats would come out in favor of extending the Bush tax cuts on dividends and capital gains? So sure, you're right to worry about year-end selling, but if the capital gains tax rate at 15% is going to be extended for 2 years, that selling is not going to happen. Why is anybody going to be in a hurry to sell at this point? So I think things are getting way better, and that's what stocks are all about.
All right, way better. That's what stocks are all about. Dave Kotok, do you agree? And tell me, give me your first top. What's your investment pick, David Kotok?
Well, Larry, this week, the last 3 days, we sold and we raised some cash. We're in the highest cash position we've been in a year and a half. We've been fully invested for the last year and a half. It's been a marvelous run. But we are developing now more uncertainty risk premiums over policy. The electoral outcome is being discounted. There's a presumption the House of Representatives will be Republican, the Senate will be close, and it looks like the market is discounting the extension of the tax cuts for at least a year while they fight it out next year. Markets are forward-looking. They're discounting mechanism, and they're discounting good news. On the flip side, if you looked into the ISM today, you saw inventories rising. And that was a number that was disconcerting if you went and drilled down into the ISM. I think we're getting into a slowdown. We've had the inventory recovery. It's time to have a little cash reserve. Whether it's a week or 3 weeks, I don't know, or a month. But I think it's time to have a little cash reserve.
All right, Don Luskin, you heard Dave Kotok. He wants to raise some cash. He's got political issues and he's got economic issues. And what's in tonight, Don?
Well, not really. I'm not looking for a V-shaped recovery here or anything. I'm certainly not looking for a slowdown, though, because we've been in a slowdown ever since the recession ended. We've had no expansion. We've just had a very, very slow, sluggish, disappointing bounce back. It's the first time in American history we've ever had a gigantic recession not followed by a gigantic bounce back. So there's nothing new about that. But when you do come from a trough as deep as we came from, one thing is for sure. That is, every company in America has huge operating leverage. So even sluggish GDP growth, even if a year forward we only pull another 3% like we did in the trailing year in GDP terms, that could be enough easily for another 10 or 15% earnings growth in the S&P, easily. So that takes you back to peak earnings. Now, I'm not saying we're going to get all the way back to PE multiples, but let's say we did. Then you're back to the old highs. You're back to 1575 on the S&P. I'm not exactly predicting that, but it is possible. It's absolutely plausible.
David Kotok, if the Fed does this QE2, if they start creating more money, expanding their balance sheet, as is being discussed widely, is that bullish or bearish for stocks given the low dollar? And by the way, I want to add this one little thing on. Our friend Dennis Gartman has come out and said gold is vastly overvalued. So I just want to put this on the table. QE2, good or bad for stocks, and what does it mean for gold and the dollar?
QE2 is not as good for stocks as QE1, and it's being talked about and it's being anticipated. You had Bill Dudley today talk about $500 billion will gain you another 50 basis points or so cut in interest rates. There's a lot of indications it may be less than that now. We had the shock of QE. The second round, anticipated, is not as vital. And if the Fed engages in it and it is not robust, then they send a message that they're running out of bullets. So the risk is rising on QE2, although it looks like they're setting up to do it. Gold. Gold has an upward bias, Larry. Gold has an upward bias. That party is not over. In our global multi-asset class, we have a chunk of gold, and we're holding it.
All right, so Don Luskin, I'll give you the last word. More money printing by the Fed, that's QE2. Will it boost gold or knock gold down? Dennis Gartman says sell gold.
I think Dennis is wrong about this one. I love the man, I respect the man, but he's just wrong about this. Even if there is no QE2, gold's going to keep moving higher. It's going to have its ups and downs like any market, but the trend is definitely higher because even with no QE2, The Fed is not going to hike interest rates. The Fed isn't going to start taking back any of its balance sheet. The Fed is easy now. And an easy Fed is like a fire burning under a pot of lukewarm water. Even if you don't turn the fire up, if you just wait long enough, the pot will boil. So if the Fed just stays as easy as it is now, long enough, the pot will boil. Have you ever heard this idea of the extended period? That's keeping that flame under the pot until it boils. And gold is going to 1,500 at least.
All right, we're going to leave it there. Well put. Cash on the one side from David Kotok, gold on the other from Don Luskin. Both of you are terrific. Thanks for coming on this evening.